Okay, let's unpack this. 2026 isn't just a new year. It's a seismic shift for one of the most controversial names in crypto, Ripple.
Mm-hmm.
For years, the whole narrative around this company has been just dominated by the grueling, exhausting legal saga with the SEC.
Right, a conversation stuck in the courtroom.
Exactly. And today, that script is completely thrown out. We are moving past the legal fight and directly into a full-scale operational global infrastructure play.
It's truly a transformational moment. Our mission in this deep dive is to analyze what we're calling the triple convergence.
Triple convergence.
Yeah, we're seeing three massive independent factors hit all at the same time: institutional finance acceptance, regulatory certainty, and just explosive market flows.
And together, they change everything.
Together, they have vaulted Ripple out of that speculative crypto assets category and into a completely new one. A core, 247 global market infrastructure provider. The foundational technology, the XRP ledger, is finally starting to justify the immense institutional thesis that has been brewing for years.
And the data supporting this convergence is just staggering. We are not talking about small pilots anymore.
Not at all.
We have seen massive, dedicated capital movement, specifically what, $1.3 billion flowing into XRP ETFs in less than 2 months. We have witnessed the SEC undergo a complete and total leadership and policy overhaul.
A full regime change.
And perhaps the single most critical development for the plundering of global finance, BNY Mellon, the custodian for $57.8 trillion, has rolled out a tokenized deposit service that directly includes Ripple Prime as a foundational participant.
Right.
This is an institutional adoption moving from if to when. It's institutional adoption moving decisively from if to how. I mean, they are physically installing the wires.
It's the elimination of ambiguity that has fueled this acceleration. When you remove the major constraints, the legal risk, the operational uncertainty, and the technical barriers, capital and adoption naturally move at lightning speed.
Right.
To truly understand the magnitude of this shift, we have to start with the largest constraint that just evaporated, the regulatory ceiling in Washington.
The atmosphere at the SEC changed on a single day, and that day was January 2nd, 2026. This was the date of Caroline Crenshaw's official departure.
That's the day.
For the crypto world, and specifically for the future of XRP products, this was, it was more than just a standard personnel change.
Oh, absolutely. It was the removal of the final, dedicated internal resistance point that had stifled progress for years.
That is the essential insight here.
It is. Crenshaw was the SEC's last remaining Democratic commissioner. She was known very publicly and consistently for her skepticism and opposition to nearly all major crypto advancements.
She voted against everything, right?
She had voted against every crypto-related approval during her tenure, including openly stating her opposition to the eventual listing of XRP-linked products.
And she was the key voice against the Ripple case settlement.
Crucially, yes, she was the primary voice criticizing the agency's decision to cease fighting the appeal in the initial Ripple case. So in practical terms, she represented the definitive internal ceiling that had weighed on the approval process and acceptance of these specialized financial products.
So when she stepped down, that political ceiling just vanished overnight.
Gone.
What we are left with is a unified Republican majority panel. Chair Paul Atkins, Commissioner Hester Pierce, and Commissioner Mark Yeda.
And this shift isn't just about party affiliation. It signals a fundamental philosophical pivot in how the SEC operates. We are moving away from the highly criticized enforcement-first tactics that defined the previous regulatory era.
That shift toward a unified pro-clarity approach is incredibly important.
It is. Chair Atkins, in particular, has a history as a staunch deregulator. His philosophy, coupled with Commissioner Pierce's longstanding support for clear digital asset regulation, she earned the nickname Crypto Mom for a reason.
Right.
It means the agency is now prioritizing market structure over punitive action. And the market recognized this immediately, validating just how much risk that single dissenting vote represented.
And the validation was dramatic. While Bitcoin also rallied on the news, moving from around $88,000 to above $93,000, XRP's response was disproportionately massive. Why the difference?
Well, it's because Bitcoin had already cleared its major regulatory hurdles months ago with its own ETF approval.
Right.
XRP, however, was still operating under the specific political shadow cast by Crenshaw's opposition. Her removal was the specific catalyst XRP needed. On January 3rd, the day her departure officially took effect, XRP jumped a staggering 8%.
Wow.
This allowed the token to reclaim that psychologically important $2 level for the first time since before the mid-December slump.
And the institutional flows amplified this immediate response. I mean, capital was clearly waiting on the sidelines for this exact moment.
Absolutely. The XRP ETF saw $13.59 million in inflows on that single day. Think about that. $13.59 million in capital deciding the uncertainty is gone, we are buying now. That surge wasn't a general crypto tide. It was capital responding directly to the disappearance of a specific, unique regulatory constraint on XRP products. It shows, high conviction.
So the story here isn't just that crypto rallied. It's that a specific, long-constrained asset was finally freed from its unique political anchor.
Exactly.
This is supported by the new SEC posture, which is focusing on constructive rulemaking rather than just using enforcement as a policy tool.
That's the structural difference for 2026. The shift isn't accidental, it's codified through actual planning. We need to look closely at Project Crypto, which the SEC first announced back in July 2025. This is the new rulebook, and it's the aha moment for any investor who previously felt paralyzed by regulatory ambiguity.
What exactly is the aim of Project Crypto? What is the goal of this massive new rulebook?
The goal is fundamentally transformative. It's about moving the market away from regulatory guesswork. For years, the market operated in this limbo, right, where every token was potentially viewed as a security subject to the whims of the Howey test.
Right.
Project Crypto's primary aim is to establish a robust and clear token taxonomy. This taxonomy will create unambiguous categories for digital assets that are definitively not securities.
Could you break down those new lanes for the learner? What's the practical difference between these new non-security categories?
Certainly. They are attempting to clearly establish 4 distinct categories. First, digital commodities like Bitcoin, which are based on scarcity and energy consumption, purely meant for value transfer or store of wealth.
Okay.
Second, network tokens, which are used primarily to access services or pay network fees on a decentralized infrastructure. This is the category where tokens like XRP are likely to fall, defining them as utilitarian tools for accessing payment rails.
So utility.
Exactly. Third, digital collectibles, which are essentially NFTs or unique non-fungible digital items. And finally, digital tools, which might be used for governance or interacting with a specific piece of enterprise software.
And by carving these out.
By declaring these 4 categories as non-securities, the SEC is carving out massive exemptions and reducing the guesswork for everyone involved.
So instead of operating in a vast, confusing parking lot where every asset is presumed to be subject to securities law, they are building clear, defined highway lanes for different types of digital activity.
Precisely. This clarity is what allows exchanges, custodians, and major banks that have stayed sidelined to finally engage. If an asset falls neatly into one of those defined lanes, the compliance burden just drops dramatically. Furthermore, the SEC is implementing a critical measure they call the innovation exemption, expected by early 2026.
And what does that mean practically for a company like Ripple?
It means speed. The innovation exemption allows qualified crypto firms to launch new tokens and innovative products significantly faster without having to go through the slow, exhausting, and costly full SEC registration process.
It's a green light.
It's a green light for rapid iteration and market expansion. The SEC has gone from being the primary roadblock, slowing all innovation, to the rulebook publisher, actively facilitating controlled growth. Capital responds directly to that certainty.
That transition from defensive regulation to constructive regulation is why 2026 looks structurally different than 2025. The regulatory framework is now an enabler, not an inhibitor.
And that enabling certainty is the essential prerequisite for the next major convergence point. Integrating this technology into the deepest, most conservative parts of global finance, the actual banking infrastructure.
When we talk about the deep parts of global finance, you cannot get any deeper or more traditional than BNY Mellon. This is the original Bank of New York, a custodian giant holding a breathtaking $57.8 trillion in assets.
It's almost hard to comprehend that number.
It is. And they have officially made their move into the tokenized deposits race, and their launch involves Ripple directly. This feels less like a crypto pilot and more like a permanent installation of new infrastructure.
It is the ultimate stamp of institutional approval. It's moving the digital asset space firmly into the realm of traditional bank accountability. BNY Mellon announced they're allowing clients to transfer deposits using blockchain rails, specifically tailored for crucial 247 operations like managing collateral, conducting margin transactions, and facilitating payments.
And the roster of firms they chose to partner with for this launch is the most revealing part. I mean, it reads like a list of the institutional titans who run the global markets.
Exactly. The initial users include Intercontinental Exchange, or ICE, which for context owns the New York Stock Exchange.
Wow.
Then you have Citadel Securities, one of the world's largest market makers, DRW Holdings, the highly respected trading firm, the massive asset manager Bailey Gifford, stablecoin firm Circle, and crucially, Ripple Prime.
Ripple Prime.
Ripple Prime, being placed in the same launch group as ICE and Citadel, instantly signals that Ripple is viewed not as a fringe crypto company, but as essential, compliant infrastructure.
The message from BNY Mellon was clear, too. Their chief product officer, Carolyn Weinberg, spoke about connecting two worlds.
She did. She emphasized that this initiative is very much about connecting traditional banking infrastructure and traditional banking institutions with emerging digital rails and digital ecosystem participants in a way that institutions trust.
That word, trust.
That word trust, underpinned by the certainty of the bank's balance sheet, is the pivot point. They are not just using digital rails, they are tokenizing the safest asset in the traditional system, a bank deposit.
Let's break down the actual utility for the learner. Why does tokenizing a deposit matter so much for a global market that wants to operate 24/7?
It solves a massive timing problem. In traditional markets, if you trade on margin or need to move collateral, you are bound by standard banking hours 9 to 5, Monday through Friday.
Right. The world doesn't stop at 5 p.m.
Exactly. If a trade happens at 10 p.m. on a Tuesday in Asia, your collateral management system in New York might be offline. Tokenized deposits enable instantaneous 247 operations, which is essential for true global continuous trading.
And ICE mentioned this specifically.
They did. ICE in particular made it clear that their goal is to support these tokenized deposits across their various clearinghouses precisely to enable continuous round-the-clock collateral management, which, as CEO Jeffrey Sprecher noted, directly increases total trading volumes.
That immediately reduces counterparty risk and improves capital efficiency. And BNY Mellon highlighted the functional power of programmable transactions.
This is a huge efficiency leap. Think of it as smart money. Programmable transactions allow the tokenized deposit transfers to execute automatically when certain predefined conditions are met.
Okay, give me an example.
For example, if a company places collateral with a custodian, instead of a manual multi-day process to release that collateral once the loan is repaid.
Which is how it works now.
Yes. The release happens instantaneously and automatically on-chain when the loan fulfillment condition is met. That minimizes human error, cuts down settlement time from days to seconds, and minimizes locking up capital unnecessarily.
And this movement is systemic. The sources confirm that BNY Mellon is far from alone. We're seeing rapid mobilization across the banking sector.
It is a race to build the new plumbing. JP Morgan is aggressively expanding JPM Coin globally. HSBC is moving its tokenized service into the US and UAE markets. Barclays is invested heavily in their UBIX initiative.
And it's not just the big banks.
No, major banks like UBS, Post Finance, and Sygnum Bank are all running tests. And even SWIFT, the long-standing global messaging system for finance, is building competing on-chain settlement infrastructure. The entire financial world is confirming this direction. The question is only who will provide the most efficient, compliant rails.
This momentum brings us to a crucial conceptual distinction, especially since Ripple has its own digital asset for payments, RLUSD. We need to clarify for the learner, what is the fundamental difference between a tokenized deposit and a stablecoin?
This distinction is critical because it reveals Ripple's dual-pronged strategy in the settlement space. Tokenized deposits sit within the established banking system.
Okay.
They are a bank liability, meaning they are fully integrated into the existing regulatory framework, potentially covered by insurance schemes like FDIC or its international equivalents, and they can pay interest. They are the digital representation of money already sitting at the bank.
And the stablecoins.
Stablecoins, such as RLUSD, are different. They are backed by reserves, physical cash, or short-term government debt, and operate outside the traditional banking liability structure. They are digital currencies managed by non-bank entities. They offer speed and efficiency, but they carry a different risk profile and are regulated differently.
So by participating in the BNY Mellon deposit launch, Ripple is staking its claim at the bank infrastructure layer. But by simultaneously expanding RLUSD, they are aggressively pushing the digital currency layer.
Exactly. They are attacking settlement from two angles. If the traditional institutions prefer the safety of a regulated bank liability, the tokenized deposit, Ripple Prime is there to provide the rails.
And if they want the speed of a digital asset.
If institutions prefer the speed and flexibility of a digital reserve asset, RLUSD, which hit a $1 billion market cap in just 7 months, is their option. This ensures Ripple is relevant regardless of which model dominates.
And this leads right back to the convergence with global regulatory acceptance. Being an infrastructure provider means you need licenses everywhere, not just a favorable ruling in one jurisdiction.
That's the key to global scale. The U.S. clarity is converging with rapid regulatory acceptance abroad. We've seen Ripple secure major wins that cement their infrastructure provider status. Take the UK, for instance. Ripple secured FCA registration and, perhaps more importantly, an electronic money institution, or EMI, authorization.
For the learner, why is that EMI authorization so crucial?
It is the golden ticket for payments in Europe. It means Ripple can offer regulated payment and e-money services under the regulator's supervision, just like a traditional bank or payment processor. This drastically strengthens their compliance credentials in a major financial hub.
And the same strategy is being mirrored in the Middle East, which is a vital area for cross-border payments because of the high volume of remittances and trade.
Correct. Ripple has made significant inroads into the UAE. They secured a license from the Dubai Financial Services Authority, DFSA, allowing them to legally operate crypto payment services in the region.
And they're already working with local partners.
Their platform is already being utilized by major regional players like Zan Bank, the UAE's first all-digital bank, and Maymo, a growing fintech firm. This aggressive expansion is specifically designed to address the issues that plague traditional international wires: high fees, settlement times often measured in days, and a complete lack of transparency.
RLUSD is also a beneficiary of this global push.
It is. RLUSD received recognition as an accepted fiat reference token by the Financial Services Regulatory Authority in the Abu Dhabi Global Market, ADGM.
Okay.
This means licensed firms within that major free zone financial center can use RLUSD for regulated financial activities. The takeaway is clear. Ripple has transitioned from a U.S. legal outlier to a globally compliant infrastructure provider, one license at a time.
And we can't forget the U.S. OCC approval.
And domestically, let's not forget the OCC granting conditional approval for Ripple and Circle to launch a national trust bank, allowing for crucial custody and selected banking services in the U.S.
With the regulatory road cleared by the SEC and the institutional plumbing installed by BNY Mellon, we now move to the third and most visible convergence point: the sheer volume of raw capital flooding the system via exchange-traded funds. The sources are calling this, quite fairly, the hottest trade of 2026, and the performance confirms the title.
The outperformance in early January was impossible to ignore. XRP surged approximately 25% in the first week of 2026.
Now it's 5%.
Compare that to Bitcoin's more modest 6% gain during the same period. This confirms what we discussed earlier. The removal of that regulatory ceiling in Section 1 allowed demand, which had been artificially suppressed for so long, to finally rush into the market.
And the cumulative capital accumulation is historic for a product so new. We're talking about high conviction flows.
Absolutely historic. Since their launch in November, XRP ETFs have amassed $1.3 billion in total assets in just 50 days.
50 days.
Here is the stunning metric. They have achieved this without recording a single day of net outflows.
Wow, not one.
Not one. Even during periods of wider market profit-taking, XRP ETFs have consistently seen fresh capital coming in. In December alone, these funds absorbed $483 million, even as major Bitcoin and Ethereum ETFs saw significant redemptions. That speaks to a sustained, high degree of institutional conviction that this is a structural long-term trade.
So we have unprecedented, relentless demand slamming into a fundamentally constrained supply. What does that dynamic mean for the token?
It creates the structural setup for massive price appreciation. The $1.3 billion in ETF assets has effectively locked up more than 500 million XRP tokens.
It's taken off the market.
Think of that supply being permanently removed from the market's active float. This continuous absorption, driven by various investment vehicles, from the physical holdings funds like the Bitwise XRP ETF and the Grayscale XRP Trust ETF, to the derivatives-based funds like ProShares Ultra XRP ETF and Volatility Shares Trust XRP2X ETF, is acting as a giant vacuum, pulling supply out of circulation.
A giant vacuum, I like that.
The scarcity dynamic is now fundamentally structural.
Let's pivot to the technical side of the trade, because the charts are now confirming this shift in momentum and sentiment, independent of the flows. Analysts are watching a technical signal called the Golden Cross.
The Golden Cross is one of the most widely respected technical indicators in traditional and digital markets alike. It occurs when a short-term moving average crosses above a longer-term moving average. Specifically, XRP has printed a golden cross on its 5-day moving average convergence divergence, or MACD, with the histogram turning decisively positive.
Okay, for our learner audience, what does that actually mean?
So the MACD essentially measures the relationship between two moving averages, indicating the strength and direction of momentum. When the 5-day MACD signals a golden cross, it suggests that short-term price pressure is overwhelming long-term resistance, signaling a potentially sustained bullish trend change.
And the historical context of this signal is why it matters so much right now.
Precisely. The last time this specific golden cross signal appeared was back in July, just before the price made its rapid ascent toward its previous all-time high of $3.68.
Okay, so history doesn't repeat, but it often rhymes.
It often rhymes. And the technical setup suggests that the market has fully digested the institutional news and is now primed for a major breakout leg, driven by that underlying structural scarcity we just discussed.
Before that breakout can truly begin, the market needed to clear out the excess risk. We saw significant action in the derivatives market, a necessary leverage reset.
That was a textbook cleanup operation on Binance futures. Speculators often over-leverage based on institutional news, and the market tends to punish them. We saw a rare two-sided liquidation event.
Two-sided.
Yeah. First, as the price surged in early January, $4 million in short positions traders betting against the rally were wiped out. Then, almost immediately afterward, the move briefly reversed, liquidating nearly $5.5 million in overly optimistic long positions.
So it cleared out both sides.
This back-to-back flush cleared out speculative leverage from both sides, leaving XRP to trade in a tight range between $2.07 and $2.07 as the market consolidated, waiting for those real underlying institutional flows to take over again.
This disciplined consolidation brings us to one of the most fascinating anecdotes from the sources.
Yeah.
The whale activity. We are seeing massive, concentrated bets being placed.
This is where conviction meets capital at an extreme scale. We're tracking the activity of a notorious high-net-worth trader who became famous in December for completely dumping their massive short positions on Bitcoin.
Right.
Now, that same entity has performed a total reversal and gone fully exposed to the upside, signaling extreme bullish conviction, particularly in XRP.
How large is this position, and what does it tell us about the conviction level?
The commitment is colossal. This whale opened a mega 30,065,443 XRP long position,
Wow.
which is equivalent to about 14.26 million XRP, utilizing 20x leverage. This is part of a larger overall $328 million long position across 4 major assets.
But the psychology is what's really interesting here.
What is most telling about their psychology is the capital commitment. Their withdrawable balance sits at $0, indicating they have gone all in on this major breakout thesis.
But using 20x leverage sounds incredibly risky for a position of that size.
It is high risk, but they have mitigated it with a deep conviction on the fundamental breakout. Crucially, the liquidation price for that enormous XRP long is still only DBER 0.3887.
Okay.
When you compare that to their entry price of 2.1027s, the liquidation price is more than 80% below the entry point. This suggests the investor is comfortable with high leverage because they view the convergence of regulatory certainty, institutional integration, and ETF flows as a fundamental catalyst that will launch the price far above its current level, making that 80% drop highly improbable in the short term.
They're not betting on a short-term trade.
They are betting on infrastructure, not short-term volatility.
It's easy to get captivated by the dramatic price action and the shiny new ETFs, but what's happening at the corporate level, the strategic long-term planning, is equally vital. Despite riding this wave of convergence, achieving market success, and commanding a massive $40 billion valuation, Ripple has formally announced no IPO plans for 2026.
Right.
Why, in this environment of maximum optimism, would they turn down the siren call of Wall Street?
This decision is the loudest possible signal that the long-term infrastructure play is prioritized over short-term market optics and shareholder demands. Ripple President Monica Long confirmed that the company intends to remain private, specifically calling the IPO process an unnecessary distraction.
An unnecessary distraction.
The core rationale is that the company already has strong access to capital and liquidity, a $4 billion investment fund, in fact. And they can fund and invest in growth without being subjected to the quarterly pressures and scrutiny of the public markets.
They've essentially built a capital structure that allows them to maintain public market credibility while retaining the flexibility of private execution.
Exactly. And that freedom allows them to execute their ambitious infrastructure blueprint. They've committed a staggering $4 billion investment into infrastructure expansion and strategic acquisitions. This is not just organic growth, it's a deliberate strategy to build what they refer to as a closed-loop system for digital assets.
What are the key components of this closed-loop system? How does Ripple ensure it controls the entire value chain?
They are strategically consolidating services. Two key acquisitions illustrate this perfectly. First, the acquisition of Hidden Road, which they rebranded as Ripple Prime.
Okay.
This provides essential prime brokerage services, the high-touch, tailored services that large institutional clients demand for trading, custody, and credit in the digital asset space.
And the second?
Second, the acquisition of G Treasury, a leader in corporate treasury and money management. By integrating institutional custody, brokerage, corporate money management, and stablecoin rails,
The whole stack.
they're building a full financial stack that traditional banks and corporate clients can plug into immediately.
The performance metrics show that this laser focus on infrastructure, even without an IPO, is generating massive results.
The numbers validate the strategy. As of late 2025, Ripple Payments had processed an astronomical $95 billion in total volume.
95 billion.
That is volume comparable to major payment processors, not just a crypto startup. And their RLUSD stablecoin, driven by the need for compliant, fast dollar liquidity, surpassed $1 billion in market capitalization within just 7 months of its launch. These metrics speak volumes to the institutional market, whether or not the company is publicly listed.
It's worth pausing on how they managed to raise such significant private capital while still being attractive to major investors. I mean, how did they structure their private fundraising to make the IPO unnecessary?
They were highly sophisticated in protecting their investors. To raise capital on their terms, they offered major investors strong protections, making their private equity essentially as secure as public stock.
Okay.
This included a crucial buyback guarantee, which allows investors to sell shares back to the company at a set price under specific conditions, providing a clear exit path.
So it reduces the risk.
Exactly. They also included special safeguards in case of a future sale or bankruptcy. These guarantees allowed Ripple to attract serious, long-term capital with public market credibility, ensuring investors felt secure, while the company maintained the freedom to prioritize its global, compliant infrastructure blueprint over short-term quarterly profit targets.
This strategic flexibility allows them to continue their aggressive global expansion, which, as we've established, is entirely reliant on achieving regulatory compliance in every major jurisdiction.
Exactly. The private strategy is the backbone of the compliance strategy. Their focus is on offering enterprise clients a legally safe, single-provider environment, backed by over 70 global licenses. Their continuous expansion, whether securing the DFSA license in Dubai, partnering with Zan Bank, or achieving EMI status in the UK, is all part of this core strategic push.
And the ultimate goal is still the same.
The ultimate goal remains solving those long-standing, multi-trillion-dollar problems that plague traditional international payments: high fees, long settlement times, and a total lack of transparency. The private structure is their advantage in winning that multi-year race.
We've talked about the capital, the regulation, and the corporate strategy.
Yeah.
Now let's step back and look at the actual engine driving all this. What guarantees that this massive infrastructure, which has processed $95 billion in volume, is safe, consistent, and provably reliable? We need to delve into the technical protocol beneath the surface.
This is where we examine the XRP Ledger Consensus Protocol, XRP LCP. The core challenge for any distributed system, whether it's a bank ledger or a payment network, is known as Byzantine fault tolerance.
Right.
The problem is ensuring network-wide consensus and preventing double spending, even when some participants or nodes are faulty, malicious, or simply delayed. XRP LCP is designed as a low-latency Byzantine agreement protocol to solve this.
And unlike Bitcoin or Ethereum, which rely on energy-intensive proof-of-work or large-stake proof-of-stake to achieve consensus, the XRP LCP manages consensus without requiring universal agreement on every participant. How does it achieve that efficiency?
It relies on the unique node list, or UNL. Every user individually defines a UNL, a list of trusted nodes they believe are honest and non-colluding.
Okay, so I choose my own list.
You choose your own list. When a transaction is submitted, your node listens to messages from its UNL to determine if the transaction is valid. Consensus is reached when a node sees a quorum of agreement, which the protocol sets at 80% of its UNL size. The network only accepts a ledger update as final and irrevocable if a sufficient number of trusted nodes agree on the exact set of transactions.
That sounds reasonable, like choosing the members of a committee you trust. But the sources we reviewed contained rigorous academic analysis that showed the actual safety margins required for this committee to operate without error are much narrower than the designers originally theorized.
They were vastly underestimated, which is a common finding as academic research catches up to deployed code. The original white paper suggested very low UNL overlap, maybe 20% was sufficient for safety. That number was later corrected upward to 41%.
But the real issue was an assumption they made.
Yes, the core issue lies in an assumption the original protocol made called Byzantine accountability.
Explain Byzantine accountability for the learner. Why is that assumption brittle? And why did removing it change the entire safety requirement?
Think of accountability like this. You trust a committee member, a node. Accountability assumes that if that member tries to cheat, say, by sending one message to you and a contradictory message to another honest peer, they will get caught immediately because everyone compares notes instantaneously.
But the internet isn't instantaneous.
But in a fully asynchronous network like the internet, where messages can be arbitrarily delayed or partitioned, a malicious node can effectively lie to two different honest nodes long enough for them to validate different transaction sets. This leads to a network fork.
A fork, meaning two different versions of the truth.
Exactly. When you remove that brittle assumption, you must rely on a far stricter requirement for overlapping trust to ensure safety.
So once that assumption is removed, what is the strict safety requirement for the current XRP LCP to truly guarantee fork safety?
The analysis, particularly Theorem 8, showed that the network cannot become unsafe without sufficient UNL overlap. The strict requirement is roughly greater than 90% UNL overlap between any pair of honest nodes.
90%. Wow.
Yes. This means that to guarantee the network doesn't break into two conflicting realities, almost everyone must agree on almost everyone else's trusted list. While the network is provably safe today, that safety relies on an incredibly high level of agreement on the identity of trusted participants.
So any big disagreement could be a problem.
Any widespread, significant attempt by participants to radically diversify their trust list would dangerously narrow the margin for error.
That feels counterintuitive for a decentralized system.
Yeah.
High safety requiring near unanimous agreement on who to trust.
That's the tension inherent in decentralized consensus. It requires a high level of narrow trust to ensure the integrity of the ledger. But safety is only half the battle. There is also the issue of liveness, ensuring the network always makes forward progress and doesn't just stall.
So can the network ever get stuck?
Theoretically, yes.
It can.
Because XRP LCP is an atomic broadcast protocol operating under arbitrary asynchrony, meaning nodes can be delayed or slow, it is subject to the famous FLP impossibility result in distributed computing.
The FLP theorem.
Named after its authors, yes. It essentially proves that in an asynchronous network, it is impossible to guarantee both safety and liveness if even one single component fails. The sources provide a fascinating theoretical example where the network could get stuck even if 99% of UNLs overlap and there are no malicious nodes.
How does that happen?
This happens if nodes partition into different belief systems regarding the current ledger, preventing them from ever achieving the 80% quorum needed to validate the next ledger update.
So the current protocol is safe as long as trust is nearly unanimous. But it can suffer from stagnation if too many participants start to diversify their trust lists and disagree on the next ledger.
Correct.
That's a huge constraint on true, large-scale decentralization, especially for institutional partners who might need different validators.
That is precisely the constraint, and that is why Ripple is actively working on the next technological leap, a solution called Cobalt. Cobalt is designed specifically to address both the extremely high trust requirement for safety and the liveness challenges imposed by the FLP theorem.
What does Cobalt achieve that the current LCP cannot? And how does it make the system both safer and more decentralized?
Cobalt is a complete overhaul of the consensus protocol. First, it requires only greater than 60% overlap for the same safety tolerances.
From 90% down to 60%.
That 60% requirement is a massive improvement over the current 90% requirement, meaning institutions and users can diversify their UNLs much more widely without compromising safety. Second, and crucially, Cobalt utilizes cryptographic randomness to evade the FLP result. By introducing a random selection mechanism, it can guarantee forward progress liveness, even with the maximum tolerated faults and unbounded asynchrony. It solves the stuck problem.
So Cobalt represents the next technological leap, designed specifically to support a system where the trust is widely diversified, making it ideal for the truly global, decentralized infrastructure that Ripple is now aiming to build. This has been a truly exhaustive deep dive into one of the most significant shifts we have tracked. To synthesize, the fundamental investment thesis for Ripple has changed because of the triple convergence. We saw policy clarity, driven by the SEC regime change and the establishment of the token taxonomy, foundational institutional integration, evidenced by BNY Mellon's tokenized deposits and the inclusion of Ripple Prime, and finally, huge sustained capital demand, signaled by the $1.3 billion in XRP ETFs.
The shift isn't just about the immediate price potential, though reaching $5 is certainly an achievable scenario, contingent on continued flows and favorable macro conditions. The real transformation is the transition from debating whether XRP is a speculative asset subject to a lawsuit. Right.
To recognizing it as a piece of mission-critical global financial infrastructure.
Yeah.
The clarity and deep integration into bank plumbing, the how of adoption, is what allows major institutional investors to stop debating legality and start building actual commercial products and services on top of the XRP ledger.
It's the infrastructure that lasts, not the volatility. They are focusing on becoming the utility provider.
Precisely.
Our final provocative thought for you, the learner, to consider as you digest this massive shift is this. We've seen that the current engine, the XRP LCP, is provably safe, but only with a narrow, near-unanimous trust margin requiring greater than 90% UNL overlap. What happens when the next technological leap like Cobalt successfully lowers that necessary trust barrier from 90% down to just 60%?
How much faster will true global decentralization proceed, and how many more trillions in assets will shift to the network? Once the institutional need for tight, narrow trust overlap is technologically removed, allowing them to finally choose validators with complete flexibility and security. That is the real scale question as you watch the next wave of institutional players enter this space.